Welcome to Learning Equinox. In our video last Monday, we talked about the various ways in which you can get funds for your startup and discussed upon the entire funding process. There, we made a mention that an angel investor as well as a venture capitalist fund your startup basis its valuation. In our video today, we shall discuss upon how to arrive at this valuation for your startup. Now, business valuations have never been a straightforward process for any company. For a mature public listed businesses with steady revenues and earnings, it's only a matter of valuing them as a multiple of their EBITDA. So, basis on the industry specific multiples, the valuations can be arrived. But it's a lot difficult to value a new venture that's not publicly listed and maybe years away from sales. Since startups are at the initial stage of business with little or almost no revenue or profits, valuation becomes a lot more difficult to arrive at for such entities. There are multiple startup valuation methods that you can use to establish the pricing based on the type of company and the phase of its growth. In our video today, we shall talk about three most common startup valuation methods. The first one is the comparable price method, second is the scorecard method, and third is the discounted cash flow method. Let us look at each one of them. In case of comparable price method, this is one of the simplest startup valuation methods. Here you value your startup by comparing it with another one same as yours. That is same in terms of the marginal rate of return, growth, production cycles, revenue flows, etc. This is not a very accurate way to value. However, it's easy to do for a good starting point for early stage valuations. The next is the scorecard method. This is typically used by angel investors by weighing up the measures of success. In this, a certain weight is assigned to different measures. For example, the team experience, the product strength, does the product has competition in the market, what is the development stage of that prototype, and such other measures. So weights are assigned to these different measures. This helps to compare your startup vis-a-vis other startups on an average in the same area or industry. If your startup looks to have an above average qualities according to their calculations, then there is a chance that you will get a higher valuation and becoming a promising investment opportunity for them. So again, this is a method where weights are assigned basis the different logical parameters. The third one is discounted cash flow methods. In this, the startup valuation method factors in how much cash flow the startup will produce over a long term. This is done by forecasting and calculating the expected rate of return on investment. Assumptions can be made about the value of the startup. This method relies on the ability of the analyst and the discount rate that they factor. Higher the risk, depending on the different factors, accordingly the valuation will have an impact. Now, let us understand what is a good valuation. Do you need to have too high a valuation or too low a valuation, and what are the implications that it happens on this too high or too low valuations at the investor level? If you undervalue your startup, the investors are going to benefit. This will mean that more equity they will get in your business. So, if your valuation is lower than it should be and you get some hefty funding at the early stage, this could mean losing a lot of equity. This will mean that in the future you will have very less equity to offer to any future investors as the value of your company has already been diluted. On the other hand, if you overvalue your startup, it will mean that you can raise more funds without losing much equity. Sounds good, right? But wait, there's a catch here. This may attract the wrong kind of investor, which may in turn affect your business in future. This may in future make your business suffer. You might also find it difficult to keep inflating the value to attract future funding rounds. Further, things can turn sour in the future if the investor feels that you have overvalued your business on paper, while actually you are not doing as well as you made them believe initially. Thus, it's very important to be just in your valuations for startup business so that a positive and favorable relationship is set up right from the beginning. Now, different startup valuation methods provide distinctive results at various stages of growth, and it's important to know when which particular method is more appropriate. Each method has its own advantages and disadvantages, which must be factored into while valuing your business. Irrespective of the method you adopt to value your startup, try to be as accurate as possible along with numbers as far as possible. This way, you can make the most of your external funding and manage your equity in the business. This brings us to the end of today's topic on valuation for startups. Now, each of these methods and even more can be studied in depth, for which we have having full-fledged courses on startup and entrepreneurship coming soon. There are going to be huge discounts and offers that we shall be offering only and exclusively to our subscribers for this. So stay tuned to Learning Equinox by subscribing to our channel. If you like this video, do give it a thumbs up and share it around. Also, do let us know your views in the comment section. Thanks for watching. Stay tuned for more.